by investing into these kind of alternative, non-correlated positions, you can actually not have to be so fearful in the morning when you turn on the news and it's the fear-mongering of another looming recession, interest rates skyrocketing, inflation decreasing your retirement account, and banking collapses robbing your piggy bank.
Hello and welcome to episode 154 of the Smart Agents Podcast. As always, my name is Michael Walter and I'll be your host. In today's episode, we are joined by Patrick Grimes, founder and CEO of investonmainstreet.com, to talk all about how you can get a jumpstart investing in your future or diversify your current portfolio. As a former robotics engineer, Patrick got his start in real estate investing in 2007 and actually lost everything when the market crashed. Fast forward 15 years and Patrick has raised over $50 million to acquire a $600 million portfolio. Throughout our conversation, Patrick shares his tips for getting started in real estate investing and explains why you should be seeking non-correlated investment opportunities. But before you get on to the day's featured interview, make sure to subscribe to the Smart Agents Podcast. You can find the show on all major podcasting platforms such as Apple Podcasts, Google Podcasts, Spotify, and Amazon Music. Also, if you or someone else on your team has an incredible story or real estate tips to share with our community, send us a message at feedback@smartagents.com. We're always on the lookout for new stories to share. All right, let's get on to the day's featured interview from Patrick Grimes. If you're interested in hearing more from Patrick, he co-authored Amazon bestseller Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities. I've included a link in the episode description with an exclusive promo code to get a free copy. Really, the way I like to start everything out is if you could just introduce yourself to us a little bit, who you are and what you do.
Yeah, so my name is Patrick Grimes, and it's great to be here, Michael. I'm looking forward to this. I have worked with many realtors and many brokers in my time over the decades. So speaking to an audience of friends, I believe here. So I started out automation and robotics engineer, a high-paid professional, started doing real estate deals back in 2007, lost everything, then kind of traded up to larger private equity deals while doing robotics over time, and then left robotics. And now I do large real estate, commercial assets. We do value add strategies. We have a recessionary acquisition fund, as well as things like diversified energy funds. And we help busy professionals, successful individuals, just like your listener, diversify out of where the employers would have them in their 401ks and IRAs or their financial planner and index funds, and give an alternative to being the DIY investor, which I imagine a lot of your audience is doing. And I can talk about my trials and tribulations, and be passive investors in private equity or commercial real estate or diversified energy or healthcare, various kinds of non-correlated assets, but be passive so they get their life back and can get all the advantages of alternative investing.
Yeah, absolutely. Yeah. I'd love to start out with, back in 2007, when what was it that got you interested in, real estate investing and transitioning in that direction in the first place?
I'm your unsuspecting real estate investor because I was clearly a geek as a kid. I mean, I was playing with Legos, taking apart VCRs, if you remember what those were, and making electronics up and through high school. And then I decided to become an engineer in college. I didn't know what engineering was back then, but then when I got into it, I was like, wow, this is amazing. And so I started out machine design, automation and robotics. And I did some really cool projects with places like Tesla, robotic assembly, their rotor, Lockheed, satellites, solar cells, medical devices for all kinds of weird stuff. And the owner of the first company I worked for is a machine design firm that specialized in automation for manufacturing. He said that his only regret was, and he's a good friend of mine, Dave Carlberg, he still invests with me today. And he said, this is back in 2006 and 7 though. And he said, his only regret was not buying more real estate sooner. And that really stuck with me because, he said that high tech is fun. It's cognitively rewarding. Like I'm sure it is for a doctor to be a doctor, or an attorney to be an attorney, or an engineer to be an engineer. But it's not going to get you where you want to be, and it's not going to get your family. You retired earlier, and your family set for success. And so I took that to heart. That's what got me started in real estate.
Awesome. And then, so obviously, at that time, the market just went crazy, and obviously there was a huge, downturn. Tell me about, going through that experience.
Well, back then, 2006 and 7, the market was never going to go down. It was only ever going to go up, right? And you could leverage everything to the hilt, and I was very eager to dive in there and take the limited funds that I have, stretch them as far as I could go. And so I did very high leverage. So it's like 90% loan to value. It was very common back then, if not 100%. And then I bought some land in a pre-development. And then I did something called a personal guarantee, which I didn't really understand at the time what that was, which means all of my other assets were in collateral with that investment. And it's really common. Most all single family investors are doing that on every loan when they sign on those loans in their own name. And then I was all in one investment. There was no diversification. And then 9 and 10 happened. Property flipped upside down instantaneously. My loan was bought and sold so many times I couldn't even find finally the predatory lender came after me, and they wanted everything that I had because they could take it, because I was cross collateralized. Everything was in that one basket, as it turns out. I didn't know at the time. And so it was painful. I paid on the loan for many years because I was hoping that this land would one day produce cash flow. It didn't produce cash flow when I bought it. I was hoping it could be developed into something that could be built on. And then when it was built, I could either sell it or rent it for cash flow or a profit. And that hope, that speculation that I did, and the way that I put it on a very insecure financial foundation where it could crumble and collapse in and take everything that I had, that was a rough time for me.
Yeah, absolutely. And so, going through all that and dealing with that, is that really what kind of led you on this path to wanting to, help people out to where they're not ever in that situation?
Absolutely. Well, especially today, right? Coming out of that, I was wrecked for quite a few years because my credit was tattered. I was broke. I was embarrassed, all that stuff. So I dove headfirst into my career. Keep in mind, I'm really good at engineering. That's like, I'm natural at that. So I got a master's in engineering and an MBA, and I started doing really well, doing some other amazing, really fun projects. My bonuses checks started coming in, and I'm like, what am I going to do with these? But I couldn't escape the fact that, I read Rich Dad, Poor Dad, and if you follow the breadcrumbs of the wealthy, it leads to real estate as being a significant part of their diversified portfolio. And that's where I was at odds. I was at odds because, I'm working in these high-tech companies like Apple and Facebook, or startups all over the place, or medical device, where people are just dumping everything in their employer's stock or their retirement account. But if you look at the diversification of the wealthy, it's only 8% of the middle class's wealth is in alternative investments outside of all those financial planner or stock market retirement account stuff. The high income earners are at 25, and the wealthy are at 50% in alternative investments, right? And so how do you even get there? How do you even find these things? And ultimately, a large portion of that is in real estate. And there's other things, like we do diversified energy funds. We have some other kinds of funds coming on deck too. And what the point is to be in not all in one sentiment driven stock market, but in tax advantaged, inflation hedged things where you're isolated or from each of the market cycles. So you're riding different cycles. We call it non-correlated. So your whole portfolio isn't down all at once, right?
Right.
And so I was hunting for this, and ultimately it all led back again to things that are tax advantaged, hard, tangible assets like real estate. And so I just had to do it differently. And this time I bought income generating real estate with fixed debt and low leverage. I put a ton of money down. I was the tortoise, not the hare. And I bought things that were cash flowing or needed a minimal lift to cash flow, could refi out capital and do it again and again and again. But I was doing it all on my own at this time because I was doing single family. But that worked, right? And I built a really cool portfolio. It just took all my time. just busy stuff.
Yeah, absolutely. So, like we talked about, our audience is the real estate agents themselves, the brokers, and, everybody we talk to, that is one of those things that they, you know, you get into real estate to get away from the 9 to 5, job where it is you're collecting that paycheck, every week, every 2 weeks. But there is, those times where cash is coming in, and other times where it's not. So having those long-term investments is definitely something that is on everybody's mind. Definitely want to talk to you about some of those things that agents can do rather, to make sure that they are starting to contribute to those investments kind of early on, so they're not sitting there waiting.
Well, yeah. So the typical approach to what I think that the American dream is work and work and work harder and harder and harder, put everything in these retirement accounts, but focus on your job and identify with your job. And with most high-paid professionals, that's really far away from real estate. And I think that your audience has a big benefit in that their profession aligns with real estate. I think that the misconception out there is that the American dream traditionally would have you graduate from being a high-tech professional to being a landlord. And what happens is you can end up inexperienced, getting into a deal, cross-collateralized, meaning you're signing your own credit on the line. The deals aren't big enough to where the lender will take the property and not you if it goes down. You're signing in your own name, not in an LLC, or you're risking a due on sale clause if you don't do it in your own name, which means you're putting liability for lawsuits. And if you go to Forbes Patrick Grimes Asset Protection, you can read some articles that I've written on just the risks associated with becoming a landlord. That took me down, and how you can build that kind of portfolio to protect yourself. And I think that what happens is they kind of graduate to this sense of, I've made it, I'm a landlord. But not only is there a lot of risks associated with that, it took all my time away. Because I was working in this high-paid career, just like brokers and realtors. Meanwhile, I was spending my nights and weekends trying to find single-family homes, renovate them, fix them up, and then getting a property manager. But once it gets big enough, you're chasing the property manager all the time. So, in fact, it was when I met my wife that I had to stop. That's when I knew that I couldn't do the single family. It was working, but I was stretched super thin, and I wasn't able to put. So that it wasn't until after I reinvented myself and I learned how to partner with people that had decades-long experience, allowed me to invest with others that were good in better markets than I was in, and it allowed for me to diversify and not have to spend all my time away from my family, friends, and hobbies to get there. And so that was my big aha moment, is I think, and I'm actually doing a TED talk on that kind of the shifting American dream, right? And not being overly persuaded by how the TV glamorizes these single family flippers or the DIY investors, because at the heart of it, you're on a razor edge or a hair from a market downturn and losing everything like I was.
Right. Absolutely. So, and that really, is that conversation between the passive and active investment, because, those single family, you're actively involved every single day in those, in those properties. So when you're working with somebody or giving advice to somebody that is looking to start their real estate portfolio, where do you, what kind of properties or what kind of investments do you suggest people really take a hard look at?
Well, first I want to say that although we have, over $500 million what we've acquired now, and a little over 4,000 units in around the southeastern states in Texas. We also have a bunch of energy deals. I am not a financial planner. I am not a CPA, and I'm not an attorney. So I'm not giving financial, tax, or legal advice. But I have been through a lot, and I've done a lot, and I can talk about what my experiences have been. And what I experienced was that, and being a bit of an analyst myself and having lost it all and regained it, When I look back at portfolio allocation, I looked at that 25 to 50% in alternative investments to invest like the wealthy. Where do I put it? Well, 3-bedroom, 2-bath is the longest running history of the most stable appreciating asset. The problem is that you can't get good debt on those without cross collateralizing yourself. They're not big enough to have local property management, and you're chasing them all the time. So if you look at the calculus of when does scale help you, that you can't really get a property big enough to fund on-site property management and it not be extremely expensive until you get upwards of 80 units. Some markets may be a little bit less. Also, if you want to get debt, which is not recourse, meaning they can't come after you, where the business, the property is actually a business, it's a commercial business that produces income, and it's valued based off of the income. And the lender will actually, it's so low risk that they'll actually collateralize it by the business. Well, you've got to get above $1 million in loan, usually 4 to 5, and you've got to get a much larger asset that's stabilized and occupied. And that's not possible to do on a single family home where if one tenant moves out, you're gutted, right? So it really took that 80 units. In fact, I did 3-bedroom, 2-bath until my next deal, which did take me, because I wanted to be active, and I still think that others that chose a passive route, still making huge income passively investing, are just as far along as the active guys, and a lot lower risk position. It took me 2.5 years. And then I did my first 86 unit. So I kind of did that leap. So my general sense is to really build your portfolio in a real estate sense. You need to get into commercial, which are large 100 to 300 unit apartment buildings, and invest in the growth markets where they're recession resilient, and invest with multiple different sponsors where you can't be the expert in every location, but you can invest with those who have decades of experience and a track record in each of those locations.
Right. When you were looking for, like you said, your sponsors and the people that you were looking to partner with, where did you turn to make sure that, you were getting the best advice and that you were, putting your money in a good place?
Well, so I'm a researcher. I run every morning. We're in Hawaii here for the summer, and I run along the beach. I listen to podcasts like yours, Michael. I listen to TED Talks. I listen to audiobooks, and I track different investments, and I'm constantly on that educational curve. So I'm always taking in new strategies and looking for new things. And what I've found is that, like on this kind of podcast, when you hear somebody that resonates with you, I would set up meetings with that person. And I do the same. You can go to my website, investonmainstreet.com or passiveinvestingmastery.com, and you can set up a meeting with me. And that's one of the great things about this platform. And so few people don't do that, but then you can opt in for the content, and you can learn about the articles putting in Forbes. I'm speaking on recessionary acquisitions in San Francisco this week. Choose some individuals who resonate with your risk profile. I've lost everything one time. I'm fighting it back. I'm a slow tortoise, not the hare kind of guy. I'm looking for low risk, diversified, non-correlated investments. And this sounds right to you. And like others, stalk us to some degree. Go to social media, learn and get familiar with these concepts, set up meetings, and then invest at one point. And that my general sense is that instead of just listening, go take action. Create those conversations. We even give a book away. Start investing and educating in your future and looking ahead. Because like I said, I had to put things on pause. I had to take a step back, put things on pause. It took me 2.5 years, and there I married my wife. Thank goodness. That's why I paused. 2.5 years later, I took a giant leap forward because I had pressed the reset button, and there was a lot of education and coming to Jesus moments and aha moments that said, look, I lost it all once. I lost all my time the second time. This time I need to stretch myself and make another step forward.
Right. Absolutely. When you, talked about the, the outside of real estate, all the different kind of pillars, if you will, of investing. The energy is one that I'm kind of interested in. What are some of those investments in the energy space that you're active in and interested in?
Yeah, so non-correlated investments means not correlated on the same market cycles of the sentiment-driven stock market. And if you look kind of at the canvas of options out there, there's actually some really cool opportunities in housing, food, energy, and healthcare. All right. And what's different about our government than, say, North Korea, right, or even China, is that the government does not, as in communism, the United States government does not fund everything. They rely on the private sector, right, to build homes and maintain homes for us to live in, to house America. The private sector to plant farms, produce food, to feed America, and to create energy sources to energize America, as well as healthcare to facilities to then keep America healthy. And so all of these things have tax incentives associated with them. And just like in real estate, if you're familiar with depreciation, where you get tax write-offs, if you're familiar with, so you get income that comes in, typically is not taxed in real estate. And when you sell a piece of real estate, you get 1031 exchanges, which allows you to buy another property without paying capital gains tax. Can't do that in the stock market. You can in real estate. But did you know all that also applies to energy? Because the government also needs you to house and energize America. And so in the energy funds, they're completely different assets. Instead of producing housing, you're producing energy. But whereas there's a lot of hate on the wealthy for not paying taxes, but the reality is that it's the government doesn't want me to go earn $1 million and buy Lamborghinis and Ferraris. They want me to go invest in housing and energy and food and healthcare because they need that. And so they're going to incentivize us to invest alongside of the United States people to provide a service to United States people through these tax advantages. And it just so happens to be that the energy sector does not ride similar market cycles as the healthcare as the housing. Similarly, healthcare tends to be amongst one of the most recession resilient markets. And one of our energy funds or healthcare funds that we're looking at right now launching is a healthcare receivables fund, in which we actually saw a huge uptick during COVID, right? And so by investing into these kind of alternative, non-correlated positions, you can actually not have to be so fearful in the morning when you turn on the news and it's the fear-mongering of another looming recession, interest rates skyrocketing, inflation decreasing your retirement account, and banking collapses robbing your piggy bank. All of these things, if you're investing in hard, tangible assets that are recession resilient and non-correlated, it helps me sleep better, helps my wife and me know that our new 8-month-old boy is on a better journey in life because I don't have one singular stream of income from one vertical in my professional career providing everything we need. I have diversified income streams in recession resilient markets. And that's really the goal, right? It's not that I think any particular one is the answer. It's that diversification of the wealthy that will get you there.
Right. Absolutely. For, somebody that is just not very, very educated in investing and things like that. I think a lot of times, one of the things that are holding people back is just simply not knowing what it takes to get into investing, what kind of financial backing they need to have already to get started. What would be some of your advice or tips for people that, are looking to make, if it's almost one of those things, like kind of put a number out there that they can kind of strive for and then say, okay, now I'm ready to start investing?
Well, many of your investors or your listeners likely own real estate, I would assume, and they probably have a rental, big or small. And what I typically do is individuals that have that, I have them look at the return on their equity. or maybe they have $1 or $2 or $300,000 in there, not what they bought it from, but what it is today, and what cash flow are they getting. Usually that's pretty small, because they're really excited about the buy, but now they have to find another buy and another buy. And so traditionally, the easiest way is to take, for real estate professionals, such as your listeners, to take some of the underutilized equity within their current real estate holdings and then participate in a 1031 exchange. We have a recessionary acquisitions fund, and they can take 100,000, 200, 300, 400. Typically, on most deals, 500,000 on their 1031 is our minimum, and then trade those forward. If you have $100,000 in a retirement account, say you have an IRA or a 401k, I have a whole article on Forbes, Patrick Grimes, retirement accounts, Forbes, and it teaches you how to, which your investment advisor and your employer's 401k administrator is not going to do this because they collect fees on your funds. Teaches you how to take a piece of that. Again, it's about diversification into an account, which would allow you to carve out in $100,000 increments for you to self-direct them into investments like ours. You don't actually need to sign on loans. You don't need to sign on properties. You're in a limited position, so you can invest $100,000 and that's it. You risk just what you have in the deal until we get it back to you, or just in cash. If if they have cash, it's typically that's another way. I think about a third of our investments come from 1031 exchanges, about a third of them from retirement account or some kind of qualified plan, whether it be a 401k or an IRA, and there's a number of others, and about a third of them from just personal funds or cash.
Right. Excellent. Tell me a little bit about, more about your book that you've written. And, obviously you're doing all these talks, but, for people that can't, be in San Francisco for your talk, the book is definitely something that they can get their hands on.
Well, the talks are always terrifying because I'm an engineer. I'm not really the flashy. I'm more of an analyst. I kept my head really close to the grinding wheel for a lot of years, just doing deals. And it was a good friend that told me, "Hey man, you got to get your story out there. You've done some things now, and you've made it out of the grind. People appreciate that." So I did band together with some other people. In fact, Phil Collins, lead guitarist of Def Leppard, so an actual rock star, really cool dude. It's a really fun project. He did a chapter in the book. NFL, NBA players, coaches, entrepreneurs, some really fun people in there. And I did a chapter. I tell my whole story. And it was the first time getting it out there. And I'll be honest, I hadn't really told it. I hadn't done a single podcast at this point. And I just wasn't natural for me. But we had closed, by that point, I had closed on like 2,000 units. And we had a pretty significant portfolio. So it was time for me to get my story out there. Persistence, pivots, and game changers, turning challenges into opportunities. Persistence, pivots, and game changers, turning challenges into opportunities. Brian Tracy did the forward of it. I did make a bestseller on Amazon. I bought a boatload just to help share these with my investor network. So if you're interested, we give it away. I think it helps get people a little bit more oomph to get going down the investment path. And, everybody needs that to some degree. So if it inspires you, a lot of cool stories. And if mine doesn't, the engineering nerd doesn't, then the rock star probably will. But so if you go to investonmainstreet.com/book, investonmain and then street.com/book. And on that page, if you make sure you put in the name of this podcast and the promo code, or is that the promo code you want to use? What promo code do you want to use?
Yeah, we'll go with, we can go with Smart Agents, keep it simple.
Okay.
Like that.
Yeah, so Smart Agents, we don't give it away to randoms, so make sure that you put Smart Agents as the promo code, investonmainstreet.com/book. Well, I'll sign it. We ship them out for free. It's my way of contributing back, doing what I can. And if anybody is interested in having a chat, you can also set up a call with me. And one of the things that I love doing, actually my wife and I were in Hawaii for the summer right now. I love spending time talking to people, trying to give back, trying to get people pointed in the right direction. If we're not a good fit, that's fine. I know a bunch of people that are in this space, and I can always usually get you pointed in the right direction.
Yeah, absolutely. Well, I really do appreciate you taking the time to talk with us today, because, it is one of those things for, in the, in the real estate space, these are people that are, they're entrepreneurs at heart, and, small business owners, and, definitely people that are thinking about their financial futures. And sometimes, like you said, just that extra little oomph to get them going in the right direction is definitely needed.
Agreed.
Awesome. Well, again, thank you so much for taking the time to talk with us today.
Thanks for having me, Michael. And I look forward to chatting with whomever out there would like to.
I really want to thank Patrick for taking the time to share his personal investing journey and tips for those wanting to grow their own portfolios. Remember, you can get a free copy of his book, Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities, by clicking on the link in the episode description and using promo code SmartAgents. So once again, if you think you or someone else on your team has an incredible story or tips to share with our community, send us a message at feedback@smartagents.com. Well, that wraps things up for this episode, but remember, follow the show wherever you listen to podcasts, and make sure to subscribe to the Smart Agents YouTube channel. Again, I'm Michael Walter, and we'll see you on the next episode.